Markets are volatile. What does that even mean? It means the price that you get for a share of stock that you're buying or selling can go up or down at pretty much any given moment. The question is it going to stay there or is it going to go back up? How long is it going to stay down? And what do you do about it? We're going to give you a battle plan for volatility for your portfolio on Consider This program. Well, good morning and welcome back to Consider This program. I am your host, Joe Clark.
And I'm Grant Soliven.
Hey, Grant is one of our senior advisors at the Financial Enhancement Group, and we are going to break down for you this nasty little word called volatility. Grant and I live at our lives as fiduciaries. That means we have to treat your money as if it were our money, and we were in a similar situation. We're legally called to that. We don't sell products or do any of that stuff. We help people create the right financial plan and then execute those plans by investing money according to what your financial vision is, not what our wishes and wants and needs are. So we're on the same page in terms of what we're getting. We use a checklist that we call the fiduciary focus. It's made up of four things. The first one is risk and volatility. Those are two different things. Fees and expenses, those are two different things. Taxes, both today and tomorrow, those are two different things. And last but not least is real return. That means we're dealing with inflation and purchasing power. We're going to spend this part of the battle plan focusing on that volatility, what it means to you, what it means to your portfolio. Grant's got some points that he wants to make.
Absolutely. Thank you, Joe. Volatility is... There's a lot of confusion that surrounds volatility. I mean, words confuse. Joe made a very important point when we were in college, as he was my adjunct professor back in 2009 when I was getting my degree in financial planning. And he said, be careful with words because they have the ability and power to educate and promote, but they also sometimes can be designed to confuse. And volatility is one of those words. I think one of the greatest stories Joe tells, in my opinion, and we've heard it multiple times in the show, is how people confuse volatility with risk. Well, Grant, the stock market's risky, right? Or the stock has risk. No, it's got volatility, right? And so inherently risk means it goes down and has no opportunity to come back up. That's not the case when it comes to investing. And so you have to be careful with words, other words that confuse people. A secular bull versus a secular bear market. What does that mean? What does that mean? How do we activate our strategy? How do we keep our strategy in place in a bear market versus a bull market? How long do they last? What does that mean? And so people spend so much time trying to dissect and trying to go in there and figure out what these definitions mean to buy highs, sell lows. They're trying to time the market, and it just puts people in really bad positions long term.
It does. So correction, when you hear the word correction used, it's usually applied to a 10% downside from the top of a market. So Aaron and Grant and Dean and Jamie and Darren will teach you to look at what we call a drawdown. A drawdown is from the high of your market account. So if you've got an account value of $1 million, that is your high water mark. A drawdown is when the market falls. How far does your account drop? Right? Obviously, our job is to fall less than what the market dropped. But if the market drops by 10%, they typically call that a correction. If it drops by 20%, they typically call that a bear market.
100%. And actually, Joe, I'm going to segue a little bit on what you just stated there about a correction. Because corrections...
You're going to correct my correction?
No, sir. I'm actually going to state this. I'm going to piggyback. Corrections evoke emotion. And we all logically know and understand that the best thing to do is to sell investments to what they're at a peak and buy them at a low. But unfortunately, the average investor, and we can show you study after study, where emotion gets invoked when pain arrives, and people do the exact opposite. And so when it comes to volatility, you have to understand what your appetite for risk is because it helps you not make emotional decisions. Because the vast majority of time, people will sell at a bottom. COVID correction, we saw it.
Yep. 08 and 09, we saw it. The tech wreck in 2000, we saw it. 2002, we saw it. By definition, when the market is at its lowest is when some people are selling, lots of people. And we've got a lady in Muncie, Indiana that has a little over $6 million. Everybody thought she was a genius because she got out in July of 2008. It's now 2021, and she's still in cash, and the market has done nothing but scream in case you missed it. That is the difference between volatility and risk, the not getting your capital back. I just got back from a vacation. Thanks for the tan comments that I've been getting from people. Page, Arizona, if you've not been to Lake Powell, it's worth going. There's nothing more spectacular in America that I have seen than the Grand Canyon, and it's just a phenomenal time. But they had the same thing. They had a dealership, and the husband walked in 2008 and said, we're going to lose it all anyhow. Just take it all to cash. Well, it's still there. And, that's where you get into some of the challenges. The reason we're talking about your battle plan for volatility is because if you get out, you have to time two things right, when to get out and when to get back in. And if you don't think you're going to have to get back in, you forgot about the four things in the fiduciary focus: risk and volatility, fees and expenses, taxes today, tomorrow, and real return. I just sat down with a lady retiring from Lilly this last week. Her pension's $6,400 a month, and that's a beautiful thing. We happen to be the same age, so I took it out over her life expectancy. And I said, the year we're supposed to die, which is about 84 and a half, because we're both 54, 55 years old, all right, it's going to take $14,000 and change at a 3% inflationary rate to have the same purchasing power. Ladies and gentlemen, you can't just leave it in cash, right? You got to time both sides of this ticket correctly, and you need to have your battle plan prepared. We use the risk barometer and a very, very disciplined focus. If you don't know, at the Financial Enhancement Group, we think that there's three things that drive a market. There is the big picture, the narrative. That's my job. The demographics, the politics, the things that are going on. Adam is our chief investment officer. He takes care of the fundamentals of what the valuation is of the market. Andrew is our technician. He's a chartered market technician, and he looks at what's going on inside of the market technically. We put the three together inside of the risk barometer, and to build that discipline that's got us through, I started 2 weeks before the crash in 87, but it's got us through the tech wreck. It's got us through 08 and 09. It's got us through the pandemic, and it's going to get us through whatever comes next. And there will be something next. You got to be ready.
Absolutely. And here's another big point. And Joe, I'm going to go backwards for just a second, if you let me. Because when it comes to confusion and having a battle plan prepared, you also have to know what the battlefield looks like. Oftentimes, people will confuse the economy and the market as the same thing. So when we get economic data, when we hear economists speaking, when we see the market, we're thinking, oh my gosh, they run right next to each other. They're the same thing. They're not. They have the opportunity to run in tandem with each other, but they don't have to move in the same direction. And that's something that we often see confusing families. Oh my gosh, let's talk about the economy. Okay, great. How is that going to affect you? Because it's not the market. And go ahead.
It's a very, very important point. So just make a note of this. Markets and economies, two different things. Grant said, rarely do they go in the same direction at the same time, or often they don't. Rarely do they. In fact, I don't think any of you would argue economically the Great Depression was a bad time for the economy. Two of the best years to ever invest were in the Great Depression. Right? So one of the expressions that I've used that may or may not resonate with you, right, is, people still call me Big Joe. I'm still not a small feller, but I'm a lot smaller than I once was, right? And so, for me to say that I am skinny would be absurd, but I'm nowhere near as big as I once was. So when you look at an economy, we care about where the company was, what that size was, and we're going in the right direction, but it's still not where you want it to be. You want that company to be able to improve every year, to find efficiencies every year, to be able to hire new people every year, to maintain market share every year. With a market, all you're looking is what is the point of change from point A to point B? Is it improving or is it declining? Adam and I like to talk about trajectory. Which way is the trajectory of the economy? Which way is the trajectory of the stock? And I will tell you, when you get into volatility, you've got to be very, very, very careful. There's a reason we have 3 parts to the way we manage money. Right? I will not argue with Andrew over the technical aspects of the market because that's his baby. He spends 12 to 13 hours a day working on the technical side. Arguing with Adam over what a PEG ratio ought to be or what the valuation is makes no sense. And I'm the one that takes care of the narrative and the big picture, which doesn't change portfolios a lot, but it does change those big waves when you start to see a tsunami coming or something of that nature. And what I see in terms of volatility, Grant, is individuals tend to understand one of those three. Mm-hmm. And the reason we pay for all three is because I firmly believe that not one is enough to get you through the dangers and the rough tide that can exist in the world of volatility. You want to be able to make the right decisions at the right time and maintain a discipline. The more you understand how that works, the better off you're going to be.
100%. And the other key piece, the element that Joe's alluding to that I'd like to speak to is the noise. Remember, words can confuse. And so oftentimes keeping noise out and process in enables you to make very good decisions, especially when change comes. And again, it is coming. There is one thing, Joe, we talked about that I want you to highlight on here as we wrap up, but it's the GM conversation. And I think it really speaks highly to volatility. Can you walk us through that?
Yeah, it's, we started the Financial Enhancement Group in 1997. And what I noticed is that people will put money into things that they can see, thinking that what they see matches the stock price that it has. And so when we watched Microsoft, which most of us in Anderson, Indiana didn't work at, when we watched Microsoft's stock price go down in value in 2000, people sold. Oh, right? General Motors, on the other hand, they didn't sell. And they didn't sell it because they could go to work, they could see the workers, they could see the buildings, they could continue to see the piles of steel. Right? They felt like the stock price was not representing the business to the best of its ability. Well, we all know how that wound up, right? You cannot emotionally get attached to a company and consider it to be the stock price. So just think about it. Economies and markets are two different things. Companies and their stock price are two different things, and you have to be very well aware of that. I've seen that volatility in Caterpillar when people said, well, when it gets back to this price, I'm selling it. Right? I've seen it with Eli Lilly stock. I saw it with General Motors. That was the worst of the three scenarios, obviously. Folks, we have to be careful. You have to have a battle plan. Get with Grant. Get signed up. For our Next Steps meeting, it's complimentary, 90 minutes. He will give you things to consider today, things you're going to want to consider in the future, and if we choose to partner together, what he and FEG will do for you, and Grant will put it into writing. You have my word and promise on that. 800-928-4001, yourlifeafterwork.com.